Hey, Dennis Tubbergen here with another video economic update. One of the great blogs that I like to read is by Mish Shedlock. You can read it yourself at mishtalk.com. I would encourage you to do that. Mish had a blog post yesterday, would have been Sunday, the 4th of March, titled Housing Collapse Coming Right Up. It's on the screen in front of you. This really confirms some of the information that I talked about last week on one of the video economic updates. I happen to believe that we're going to see not only a housing collapse, but a big decline in stocks and a big decline in bonds. In fact, last week, Friday, I talked about and showed you in the market analysis a perfect textbook head and shoulders top in the bond market. Now, Mish, in his blog post here, quotes and talks about the Black Knight Mortgage Monitor, and he opens his blog with a chart that you see here on your screen. It's the national payment to income ratio. Now what that is, it's the percentage of the median household income needed to purchase the median home using an 80% loan to value 30-year fixed rate mortgage. So right now it takes 23% of the median household income to purchase the median home. That's up from 17% here just 5 years ago. Now, there's a few points made here that I will talk about, but the first point really is the most important one. Recent rate jumps coupled with climbing home prices have increased the cost to purchase the median home by $67 a month. That's up 6% over the past 6 weeks. Now think about that for just a minute. The cost to purchase the median home has gone up 1% per week for the last 6 weeks, for a total of 6%. Now, that may not sound like a lot. However, that is an unsustainable rate of increase. After 6 months or 26 weeks, that would mean the cost to buy this home would have gone up 26%, over a year, 52%. How high can it go? I don't know, but I do know that is an unsustainable rate of increase. Second point, it costs $1,141 in monthly principal and interest to purchase the median home using a 30-year fixed mortgage with 20% down. That's the largest since 2008. Now, here's the other big point that I want to make. And again, you can go read the blog entry for yourself. I'd encourage you to do that. But here is the big issue. The refinance opportunities for existing home buyers are the lowest that they've been since 2008. Mish writes this: anyone seeking to refinance will discover the opportunities have essentially vanished. Anyone needing to refinance to lower their payments is in outright trouble. You can't do it. If you can't make your payments, you don't have a refi option now if you're most people. What does that mean? Mish says it really well at the end of the blog post. He said the more hikes the Fed gets in, the bigger the collapse and the bigger the resultant deflation. The only thing that we have to be concerned about is what the Fed's actions might be. If they decide to print again, we could get inflation followed by deflation. However, if they don't, I believe Mish is right on target here. We're going to go straight to deflation. What does that mean for you? There's a lot of assets that don't like deflation. Real estate is one. Stocks are the second asset class that don't like deflation. If you're thinking about selling real estate, now's a really good time to do it. If you're thinking about buying real estate, now's a really good time to sit on the sidelines. If you have stocks in your portfolio, despite the fact we're seeing a little bit of a rally today, we're still skeptical, and we believe that many investors ought to consider protecting their open positions with trailing sell stops. That's today's video economic update.